truth is, commercial has massive advantage over residential because of that law. Plant and equipment, that's where you get the crux of your depreciation from, right? You could claim that probably 15 to 20 grand in the first couple of years in just depreciation on a 50-year-old property. So he was entitled to a 200 grand write-off on depreciation because had no idea. That's a massive tax benefit. It costs a consumer or a property investor nothing to find out what the depreciation is, right? You will get a very good return on that investment.
That's definitely a rewind for business owners.
Let's talk depreciation, one of the most overlooked but powerful tools in commercial property investing. We're joined by Tuan Duong, founder of Duo Tax. He joins us to break it all down from what you can claim to how asset types differ to the biggest mistakes investors make. Whether you own warehouses, medical centers, or mixed-use assets, in this episode, we'll help you boost your after-tax cash flow and sharpen your strategy. I hope you enjoy the episode and don't forget to follow and rate.
Tuan, welcome to the show.
Thank you. Thanks for having us, guys.
Mate, you're a returning guest of our mini podcast at InvestorKit, but today it's all about the world of commercial property. And I want to understand the biggest differences of commercial depreciation and residential depreciation. Tell us more about that.
Yeah, so the biggest advantages of investing in commercial versus residential, the clearest one is that you don't have this problem with Division 40 plant and equipment. Plant and equipment in a residential setting, you cannot claim depreciation when it is secondhand. With the plant and equipment in a commercial setting, the rules have never changed. So essentially in residential, the 9th of May 2017 was the cutoff date for claiming secondhand plant and equipment. So you no longer can do that if you buy an existing property in residential. With commercial, that never changed. So even if today you buy an existing property that's old, very old, the ATO will still let you claim depreciation on secondhand plant and equipment. So that's the biggest difference. And of course, in a commercial setting, owner-occupiers can claim depreciation. In a residential setting, if you're an owner-occupier, you can't claim depreciation. So there's some of the clear advantages when you go into commercial. Even if you're owner-occupying for yourself, for your business and whatnot, you can claim that's depreciation full, both plant equipment and capital works. That's
a big one. So 2 parts. It's almost like is that the depreciation's world of D-Day, like your 2017 in May? Is that the scary day for depreciation?
You remember those days? There was a lot of noise for sure. People not sure what the legislation meant, but for sure, I think given the amount of time, it's been 8 years since that legislation, people have become accustomed to not being able to claim that depreciation. Yeah. But of course, in any depreciation, any property, 80% of the depreciation is in the building, the structure, and only 15 to 20% usually lies in the plant and equipment.
So there's 2 big things I'm taking out of there. Number one is the commercial world of depreciation never changed, which means there's always a strong deduction sitting in there, right? Almost always. And secondly, so many people have that misconception of, this is an older property, surely it shouldn't have it, which you said, no, look, on commercial, it does. Look, check it. Is there a cutoff date that you say, hey, work from this date onwards for commercial property?
Yeah, so on the date that the ATO uses is the 17th of September, 1987. Okay. So from that date, you can still claim building depreciation. Anything built after that date has that 2.5% of the total construction costs. So that means if you've got a commercial property today, built from 1987, you can still claim the construction costs. But even if you miss out on that, so if you've got a property that was built in 1960, for example, and you buy it today, that commercial property, yes, you don't get to claim the building depreciation, that 80% I was talking about of the construction costs back then, you still have 20% of the plant and equipment costs. So even if you go and acquire a building today and it's very, very old, 50 years old, for example, you could still claim the residual value of all the plant equipment. So if it's got an old aircon, old carpet, heaters, fans, all these old plant equipment assets, you could still get the residual value, which a quantity surveyor can assess, and then claim the depreciation on that. And if you're talking about big warehouses, commercial properties that are, expansive, an old hotel, for example, motel, all that good depreciation on plant and equipment, pool pumps and what have you, if there's a common pool, you could claim that even in today's money, and we could get a depreciation schedule for the next 10 years on that 50-year-old property and still claim potentially 50 to 100 grand worth of plant equipment. So what's that talking about? Probably 15 to 20 grand in the first couple of years in just depreciation on a 50-year-old property.
This is the world of this is what happens when it's an unknown world for you and you don't know what you know and you don't check, which is a really good segue into like high net worth investors who are buying commercial property. Hearing what you've said, what are the things that they should really be focused on, or how should they use depreciation to help them get ahead? Do they reach out? Do they just go speak to their accountant? Do they speak to your team? What's the actual process and the mechanism for an investor like that to actually understand their depreciation claimable?
Yeah, and it's the most important thing, of course, is always getting the right team. You know, if you've got a great buyer's agent that gives you the advice on buying a property, knowing all the metrics behind that. And one of the things in commercial I would heavily weigh on is getting the depreciation value. And if it's the buyer's agent referring you, fantastic, but usually an accountant is always going to look after your tax position, making sure that you're taking advantage of all of these tax deductions possible. And depreciation is one of those things that you should be looking at. And so, yes, getting the advice from an accountant and, of course, doing your research around that. But the truth of the matter is now with the software available in the marketplace, it costs a consumer or a property investor nothing to find out what the depreciation is, right? It's literally, we've got now an AI tool. You plug in their calculator, our depreciation calculator, put in your address, and we're pulling data from all the residential photos or commercial photos that you have online. And then if we've got properties inside of that region, we can pull that data and give you a depreciation estimate that I would say is somewhere between 80 to 90% accurate as to what you would get. And usually with commercial being heavily inflated now because of the ability to claim all that plant and equipment, you will get a very good return on that investment.
Got it.
How much is the depreciation schedule fee, like range-wise, price-wise?
So usually charging for $700 for a commercial property which was a small office suite or for example, a small warehouse, and that price will depending on how large of the scale of the complexity of the commercial property is.
Okay. Now, last question from me on this particular part for the high net worth investors. They're investing in trusts, in SMSF, in company structures. Does this change whether they should look into it or not? How does this help their cash flow there?
Yeah, great question, and something that we always advise, especially a property investor. You've got a property investor, typical scenario for us is, I've got a family trust, purchases a commercial property, and we also run a business. So the family trust purchases the building. They're claiming depreciation on what's already there, right? And then you've got the business that they also own, right, in a corporate, entity. They would run that business. Now, when they occupy the building, they're claiming depreciation on the building, any strata that's tied to the building, but the business entity will be able to claim any depreciation on the fit out. Now, importantly, when the business opens the business and runs a business from that premises, usually what they would do is, most likely, do a new fit out to the property. That premises will then need to demolish its old fit out, right, in order to reinstate the new fit out. The demolition of that fit out, because it was already there, if there's any existing fit out that's depreciable, that belongs to the family trust. The family trust bought the property. There's already an existing fit out. So if you're going into a property, for example, myself, we occupied a building. There was about $165,000 worth of existing depreciable fit out costs. We could claim potentially $15,000 per year had we used that fit out. But because we demolished the fit out, we don't claim $15,000 per year. We're claiming $165,000 as a tax write-off in the first year for that family trust. That's a massive tax benefit. And then at the business level, the business will then claim depreciation on the brand new fit out. So these things are some of the things that people miss. Now, that's a great example of where the fit out. Now, if I was a commercial property investor and renting out that property, yes, I have the fit out there. And if the fit out belonged to the tenant, fantastic. The tenant gets to claim the depreciation, right? But as the time goes on and the tenant decides to leave that premises and they leave the fit out behind, guess who owns that fit out?
Yeah, massive.
It belongs then to the lessor, the vendor or the owner of that property. And so essentially you get then to claim the depreciation of that fit out based on the quantity surveyor's assessment. Should the next person demolish that fit out, that also then belongs to the landlord as a tax write-off as well, because that's another scrap value that's entitled to be claimed by the investor.
So touching on that, Tuan, so we have different types of assets when we purchase for our clients. Obviously, medical, warehouses. How much does a type of commercial property or the asset type change the depreciation outcome?
Drastically. Of course, like if you're in an expansive warehouse space that might have storage racks and whatnot, your depreciation per square meter is going to be very low, right? Because you've got tilt-out panel concrete walls. You might have a mezzanine office or very basic fit-out for a mezzanine office space. Then you go into something like retail. We've seen, and so a warehouse might only cost $800 to $1,000 to build, if depending on its expansiveness. But then you move into a retail space, you could be paying $2,500, $3,500 for a basic retail office fit out. Then you can go into high-end luxury. And if you're looking at a Louis Vuitton store or something like that, you could be paying something like $10,000 to $15,000 a square meter. So almost 15 times the cost of a warehouse. And so these type of things are really something that's going to heavily weigh on the depreciation, and it's worthwhile getting that assessment beforehand, especially if it's an owner-occupied space. Are you leasing it out, or are you going to be owner-occupying it in your own business? These are some of the things to be looking at beforehand.
So for an investor looking to maximize depreciation through upgrades, so you mentioned, mezzanine floors in office warehouses, where do you find the best return is at the moment? Say you're an investor, you're looking into making an uplift play, and you want to get a good depreciation benefit. Where would you look?
I would definitely looking at, high-end fit-outs is always going to give you the highest amount of depreciation, especially if you're looking at plant and equipment. That's where you get the crux of your depreciation from, right? So ducted air conditioning units, the type of fit out that you do, if it's high end in nature, lighting, they're all plant and equipment items, right? If you're using carpentry that's expensive, wall fixtures and whatnot, that's going to give you a lot of that. Anything that's motorized will give you the highest amount of depreciation. And so essentially that's the type of thing I would be looking at. High-end kitchen, that you put into, we're doing an office fit out now for our new office in Parramatta. We're putting a full-blown kitchen in there. And that's the type of thing that's going to give you a massive depreciation, range hoods and ducted range hoods and whatnot, nice fixtures and fittings. So I'll be looking at plant equipment to get the most out of your depreciation, because you get to write them off. Why? The effective life on plant equipment, such as, these motorized equipment like ducted aircon and whatnot, they've got a very short effective life of, say, 5 to 15 years, whereas the building in a in a commercial space like an office or a warehouse is 2.5%. The only time you get accelerated depreciation on the building is when it's manufacturing, hotels or motels.
Loving the show and keen to invest? Well, book your free discovery call and we'll actually walk you through how to build a high growth portfolio without all the guesswork. Just jump onto the link in the show notes or visit investorkit.com.au to book your discovery call. And now let's get back into the show.
So Tuan, we recently worked with your team on a industrial property out in Victoria, $4 million. This is what it looks like here. When we approached your team, what was the depreciation for that $4 million asset? It was about 3 years old, about 2,000 square meters in land, and about 1,200 square meters in NLA. What were some of the things that your team was looking at in that property?
Yeah, and so of course the potential, because there was $60,000 in just the first year of depreciation alone.
Wow.
It was a huge benefit, but that not only is that, but because of the plant and equipment is still in place, you can drag out that depreciation and preserve sort of 60 to 40K worth of depreciation over a 10-year period. So not getting 60,000 just in the first year, we're sort of hovering around the 55s, 40s, but over a 10-year period at the very minimum. And so that type of depreciation is going to yield the client very good return, but that's on the back of the fact that it's got a mezzanine. The property had, I believe, a crane in the property. And so there's a lot of these items here that people don't know, understand, but they're plant equipment assets. And the beauty of commercial is that you can claim plant equipment, even though it's secondhand in nature. And that's the beauty of really getting into the commercial space.
That's a big amount of cash flow. And that's actually, again, we buy it for a yield game, a cash flow play. That doesn't exist the same way in residential. What would a $4 million residential property have been like if it was established? Maybe it's gotten one of your nice kitchens or anything like that. What do you think something like that would have been in comparison?
And this is the biggest issue there is like in residential space, a $4 million property. Yes, even if you talk about something that's got a decent build on it, you're probably only going to achieve something like 10 grand, 15 grand at the most per year, because what's happening is a lot of the plant and equipment is where you're getting the value to get the depreciation up to 60 grand. All of that is offset or foregone because of the way that the legislation is set up, that residential properties after the 2017 purchase date no longer can claim depreciation on plant and equipment. So all the oven, all the range wood, of course you don't get a crane inside of a residential property. You might have a lift, but not in a $4 million property, right? Usually you need a 10 to 15 or $20 million property to get a lift these days. And so generally in nature, a $4 million property, especially where the median house prices are, you could expect to have very little depreciation on a $4 million home. 10 to 15 grand is still good, but it's not $60,000 good like a commercial property, like with the example that Chris gave.
That's massive. And when it comes to a yield play, commercial investors, if you're thinking of this, you can do two things. Number one is you can go a little bit more aggressive on an asset or different pool of assets out there and realize that your yield will be made up in depreciation too, because it won't just be like, hey, look, maybe it's a 6%, but what if I went for a 5.8% and I have now 5 assets to choose from? My depreciation will bring that yield back up to over 6 when I look at the actual post-depreciation cash that I get. Or secondly, you can go, well, no, I want to keep for the 6, but then now I'm getting 6.3, 6.4% net yield returns equivalent because of all this extra cash flow coming back from the depreciation. So big game changer there, Tuan. Really appreciate you sharing that. Tuan, when it comes to investors and the mistakes they make, what are some of the traps or mistakes or missed opportunities that you see investors make when it comes to depreciation?
Biggest one is definitely going to spaces and people not being aware of what they're entitled to. I had a guy in a pizza shop, right? He owned a pizza shop, something about, I think it was the fitted out was about 450 grand originally about 10 years ago.
Is that some like Dubai pizza, like gold on the pizza or something?
It was a big pizza shop that we looked after for a client in Sydney. And the fit out was estimated about 450K about 10 years ago. Yeah. He got into that place and he was like, I'm not happy with it. He decided to demolish half of it, came to us for a depreciation schedule. And then I said to him, did you know you're aware you can claim the residual value on what you scrapped? He goes, had no idea. So he was entitled to a 200 grand write-off on depreciation on that in that year. And it was a very successful pizza shop that he was running, as you can appreciate, for something that's worth that much. And so not only did he have that 220 grand write-off, we were able to do a new depreciation schedule for that new 400 grand fit out that he did. And he was able to get approximately something like 15 to 20 grand on average in the first 5 years in depreciation. So think about that for a business. Your business is turning over $1 million, 220 grand straight off your tax bill in the first year. You decide to scrap that, that part of that pizza shop to redo some of that, especially on the front facade there.
That's definitely a rewind for business owners. They're listening to this podcast. They need to go back to that specific part, because there's two parts here. You've got the depreciation on the scrap. You've got the depreciation then on the ongoing. And that's a lot of your fit out back. Like that's, almost 15, 20% of your fit out costs back.
Yeah. And
just like that.
20% of your turnover as a tax deduction. I think that's a big play for any business, right? Because, of course, anywhere you can minimize tax, and yes, the depreciation is great, but a huge tax write-off, it's massive impact for any small business.
And that's the D in EBITDA. Do you know what I mean? Like it's still real money that hit your accounts, but on tax, it was less.
Yeah.
And so that's that earning before it all, right? Yeah. So from that perspective, I want to understand then, when it comes to business owners or commercial property investors, how much do you see people just not actually ordering the report? Like, are there so many people out there that just don't even realize that they could be actually ordering these reports to get all these benefits? Because to me, I'm just sitting there, how many misconceptions there must be where investors are sitting there and going, oh, my property's too old. Surely it can't be depreciated. Or, oh, you know what? I didn't pay for those fit outs, or I bought that and it was like that when I got it. I didn't do them. Surely it can't be depreciated. Is this a big problem you see across Australia? A
huge misconception, Arjun and Chris. I guess, particularly because people are so comfortable investing in residential that they almost take that knowledge and apply the same to commercial. And the truth is, commercial has massive advantage over residential because of that law. That law that plant and equipment depreciation doesn't have any cutoff. If you purchase any property, any commercial property today, you'd be entitled to at least, I would say, the least I would ever see is 20 grand worth of depreciation. And that's over a 5-year period. That's on the oldest property, yeah? I'm talking about a property that's from the 50s. You build it where you buy a small motel with 4 rooms. You could claim 20 to 30 grand at the very least over a 3 to 5 year period. And so it's the biggest misconception because people are so comfortable with saying, oh, accountant says, oh, old building, probably not worth it. Truth is, costs you nothing to find out. Flick someone, a quantity surveyor, an address that you have, even if you haven't bought the property. Get an estimate as to much depreciation you claim, and you'd be surprised what's entitled. And of course, buying an old property is one thing, and when it's commercial, most likely, what do you do when you buy an old commercial? You're probably going to do it up. You're going to put some money into it, capital inject, fix up a few things, and that's always going to be worthwhile. So definitely it's a big miss for people and a misconception that can definitely be ironed out if you do a little bit of research, get the right advice, talk to the right people, part of the process.
Yeah, minimum 20K like depreciation, because commercials are cash flow play. It's heavily positively cash flow.
Metrics.
You know, if you're earning 70K, for instance, for a commercial property in passive cash flow, and you're getting a 20K depreciation benefit, that's huge.
Yeah, absolutely. Well, Tuan, accountants and the specialist quantity surveying companies like yourself, it's another big mistake people make. And they think that, oh, I just go to my accountant and speak to them about depreciation. But we know the accountant's coming to you. Like, do you know what I mean? They're coming back to you for the full report and everything. So how do people reach out to your team? Because we know for every transaction we do, we're saying, hey, speak to your team at DuoTax because that's how they can figure out if that property is depreciable. But there might be any commercial owners listening to this podcast or business owners listening to this podcast going, I've got a few commercial properties under my belt already and I didn't know some of these things. How do they reach out to you and your team?
Yeah, so of course, reach out to Tuan at duotax.com.au. That's TUAN at duotax.com.au and mention, of course, InvestorKit. We've got some exclusives and whatnot. And the truth is that accountants, they've got a job to do. Their job is to understand everything about tax, right? And their job is to advise you when there is opportunities to reduce your tax. And so for us, we're also tax agents, but we don't do tax returns. Quantity surveyors assess construction costs, and their expertise is in finding out what is depreciable within your property and help you get the most out of that by working out how much depreciation you can claim this year, next year, and for the foreseeable future, but also finding out those big tax write-offs that you can claim. So any scrap value that you're looking for, even give you an indication, hey, you know, this fit out is worth 200 grand. If you decide to do a new fit out, you'd be entitled to this write-off. That's a big decision for someone. Someone could actually go, I wasn't thinking about doing a fit out, but if I'm going to get 70 grand as a write-off after tax, why not? So it's a big play, right? In terms of running a business and seeing what that, and of course, reinvesting 70K back into your business has a massive impact for potential growth in the business.
Absolutely. Well, mate, we've loved having you on. We can't wait to see the new DuoTax kitchen in Parramatta. And at the same time, I hope you got a lifetime membership of pizza after saving that business owner so much money there. Mate, it's a phenomenal thing that so many commercial investors aren't aware of, business owners aren't aware of. And I hope after listening to today, they can stop leaving money on the table and reach out to your team at DuoTax. So thank you so much.
Thank you.
Cheers.
Thanks, guys.